Good afternoon, everyone. Just double checking. John, are you there?
I am here.
Excellent. Great, great. Well, why don't we get started? It is 3 p.m. Good afternoon and welcome to our market update webinar. My name is Sean Kimji, and I'm the Vice President of Wealth Management at Alterna Savings. Today's webinar will be a conversational format on markets, pre and outlook, responsible investing, and we'll touch on other factors such as the election and pandemic influences. This webinar is being recorded and all participants will be in a listen-only mode. You may submit a question using the chat function and we will endeavor to address it as the questions come in. I would now like to take a moment to introduce my colleague here, John Bai. And John, I'm going to read your bio, even though some of them may have heard it, but I think it is important because you do have a long and very deep history. So John joined NEI in May of 2019 and is responsible for the firm's asset allocation and investment strategy, sub-advisor research, and due diligence, and is a key partner in building strong relationships with our advisor community in both credit union and intermediary channels. John brings more than 25 years of investment industry experience, having worked for some of Canada's top financial institutions. Prior to joining NEI, John led product and investment teams at Merrill Lynch Canada, TD, Dynamic Mutual Funds, and Hollis Wealth. There he founded and chaired asset allocation and investment portfolio committees, led manager oversight activities, and was responsible for research teams that covered equities, fixed incomes, mutual funds, ETFs, and alternative products. John holds a Bachelor of Commerce degree in Finance and Economics from the University of Toronto and is a CFA charter holder. So certainly a lot of experience and a lot of knowledge. Glad to have you join us, John. So why don't we just dive into it? We've got a number of questions that came in, John. And I guess the first thing that, we get asked a lot of is, the market growth. When we take a look back at, what we've seen over the course of this year and even since the pandemic started, coming out of the bottom of the market, we've seen that growth and it seemed to have continued and it hasn't really subsided. Perhaps you can comment to what has contributed to the market performance we've seen year to date, and maybe even touch on valuation, because it seems that a lot of folks believe that things are getting a little expensive in today's markets.
Yeah, great, Sean. Thank you so much for hosting this market call, and thank you very much for having me on the call. I really enjoy these, and I want to welcome everyone who have taken time out of your very, very busy day to be joining us on this timely market call. So yes, let's get started here with your great first question. You're absolutely right. The year to date and performance since the bottom of the COVID has been actually very strong. The stock market, the US stock market, measured by the S&P 500 index, is up around 100% since the March 23rd lows. In Canada, the TSX index is up almost the same. But this year has really been very different than last year. Last year, we saw extreme volatility, one that was characterized by very swift and violent moves, both on the downside and then on the upside. First led by technology, then it broadened its base once the Pfizer and AstraZeneca vaccinations were announced late last year. So fast forward to this year and this summer, this summer has actually almost been the exact opposite. The last 3 months, the bull market has been incredibly quiet and resilient. Just to give you some stats around this, Sean, we've actually gone 214 trading days without a 5% correction. That's extremely rare when you look back over the last 100 years of trading history. We haven't really seen a 5% correction in the equity market since last October. So that's downside volatility. Upside volatility has been very muted as well. In fact, we haven't gone without a 1% rise in the equity markets for the last 34 days. That's the longest in 20 months as well. So, it's been very steady, very resilient, just upward, just tick by tick by tick. And all of those small ticks have been quite good. The S&P 500 is up about 20%. The TSX is up a smidgen below that year to date. And the markets have been up 7 straight months, the longest winning streak since 2018. So pretty ho-hum, steady, unexciting rise. But, beyond that, the market has really had to overcome, a wall of worries, high inflation, We had some inflation data come out of the US this morning, rising Delta variants in Canada, Ontario, US, and around the world. In fact, August was particularly worrying as some states, counts and hospitalizations, has risen to new highs since the start of the pandemic. So that was very worrying. And then we saw, the UK numbers as well as global data numbers tick up. And that's really caused weakening economic data. And so if you look at the Citigroup Surprise Index, and what this index does is it looks like every economic indicator that comes out and it tracks whether it's surprising on the upside or downside. And that's gone from close to 100 down to negative territory. And so that's just showing you that the economic data was beginning to weaken in the emerging markets. China data has been worrisome as well. So you've really seen some of this worry dropping off. But so in that wall of worry, why has the markets been so steady? And I'll just point to Sean just 3 quick things before I'll turn it back to you. But it's the same old suspects. You've seen still very accommodative central banks. The Bank of Canada and the Federal Reserve still have their policy at the lowest rates, record low rates. The US hasn't announced that it's ready to take stimulus in the form of asset purchases off the table yet. And so this means that bond yields are incredibly low, and that's great for stock valuations. And we'll talk about that just in a second. And we've seen great fiscal stimulus from federal governments around the world. If you look at the IMF, they track this, and they say it's 16 trillion since the start of the pandemic. And most recently, we talk about the U.S. Infrastructure bill and another spending bill behind that in the $1 trillion range. And then finally, and this is super important, is earnings. Earnings for corporations have been incredibly strong, driven by the reopening of the economy. In fact, if you look at the S&P 500 earnings, the second quarter earnings season, which just ended, was incredible. 90% of companies beat earnings estimates, and year-over-year earnings are set to be up almost 100%. And so all told, earnings now are 27% higher than pre-pandemic levels. And so what that means is, the stock market returns that we've seen here, earnings growth has accounted for more than 100% of the rise in stocks. And so valuations really haven't been stretched when you look back over the last 12 months. And so, the forward PE ratio, Sean, you talked about this. Valuations are a concern, no doubt about it. 12-month forward PE ratio is about 20 times earnings. That's at the top end of the range. The 20-year range here is about 8 to 22. So 20 is fairly high. However, equity valuations, look more attractive when compared to bonds. And that, and just to give you one metric, PE ratios is just price divided by earnings. Earnings yields is the exact opposite, earnings divided by price. And so when you look at earnings divided by price, that's roughly 5%. That 5% compares to just 1.31% on the US 10-year bond. So very attractive relatively. And that's really what's supporting the good equity valuations that we see here. So bottom line, Sean, is that, relative to bonds, equities remain attractive. We have a very strong economic growth environment that should ensure good corporate earnings on a go-forward basis, and that will be the primary driver of equity returns going forward. Not expecting anything crazy, but the economic environment should drive high single-digit earnings growth. That seems very doable, and we'll just keep an eye on how inflation and wage inflation will lead into corporate margins. But on the whole, we believe this is a very good environment for equities.
No, that's great, John. A good sort of synopsis on where we valuations are, where the markets are brought us. And I do want to come back to sort of the outlook, but we'll come back to that a little bit later in the webinar because I do have some questions around the earnings, the stimulus, and the support that central banks have provided. But I do also want to touch on responsible investing as a theme. We're seeing this more and more in a lot of investment strategies today. It seems like everyone is starting to promote responsible investing, and this is something that NEI has done for quite some time and has been heavily involved in this space. So I'd like to perhaps you can speak to the NEI process a little bit, some of the history of the responsible investing, and how it's becoming more and more relevant and important in today's environment, especially given some of the climate issues that we've seen lately.
Yeah, no, a good question. And as you mentioned, we at NEI are no strangers to responsible investing. We've been Canada's leader here for the last 30 years. Launching our first responsible investment fund over 30 years ago. So this is definitely not a new topic for us. In fact, we've been cheering from the sidelines, encouraging other asset managers to join us on the incorporating responsible investment approach into the managing their money. What we are surprised about at the speed at which the industry is adopting this approach. And so, it's such a big topic, and I could speak probably the entire day on this, but, let me just first define responsible investing just for your listeners so that we're starting off with so responsible investing is really an investment approach that integrates long-term, what we call ESG, or environmental, social, and governance factors into the investment decision-making, with the objective of generating superior risk-adjusted financial returns. And so really, traditional money management, when they select securities, they look at sales growth, earnings growth, balance sheet, valuations. And what responsible investing does is that it actually furthers that and incorporates environmental, social, and governance factors to do that. And so why would an investment manager do that? Why would a portfolio manager take the extra time to incorporate ESG criteria into their decision making? And really, number one is that because it makes investment sense. Responsible investing, ESG investing, is a well-researched discipline. It's been the subject, Sean, of literally thousands of academic studies over the years. And the academic studies have shown quite resoundingly conclusive that that responsible investing will reduce the corporate cost of capital. 90% of the cost of capital studies show that ESG standards lower the cost of capital for companies that are good stewards of the environment and social issues. On the operational performance side, 88% of the reviewed studies show that ESG practices result in better operational performance. And that better operational performance leads to the third point, which is stock market performance. 80% of the studies show that stock market performance is positively influenced by good corporate, environmental, and social responsibility practices. And then the last thing is all around risk protection, which again, is something that we take quite seriously about managing your money for your members. And that virtually all the studies show that RI investing provides more downside risk protection, especially during times of social and/or economic crisis that we saw in 2020. And again, 2020 was a great year where, again, both NEI and other RI strategies outperformed their non-RI counterparts. And so, again, strong reasons for this. And I guess, if you want to say, what how climate change and how NEI begins to contribute into the space. Climate change is a really good example, of a risk that we think, needs to be on every investor's radar screen. We have a huge UN climate conference coming up in November in Glasgow. It's equivalent to the Paris Accord, and the science is, unequivocal as well. We're running out of time. According to the Intergovernmental Panel on Climate Change, the path to limiting the effects of climate change to 1.5 degrees or 2% is narrow and won't be achieved unless we take bold and urgent action. And so, the International Energy Agency, the world's leading think tank on energy, says to reach net zero emission really requires the world to ramp up investments on the energy infrastructure side to $5 trillion per year, $5 trillion per year annually. So it's impossible for public monies to do this by themselves. We really need a public-private partnership. And so for the companies that actually want to be part of the solution, the economic opportunity is huge. And so how does NEI really impact this? For us, I just want to remind you, your members, of the NEI business model. We are an $11 billion asset manager, but what we do is we scour the globe for the best money managers to look after each one of our mandates, whether they be high yield bonds, global equities, Canadian equities. And so we have 17 sub-managers that collectively manage $7 trillion of assets. And so we have access to $17 trillion of investment resources to really manage your money. So on the first level, we actually own the securities. So what we do is we have conversations with the companies that we invest in to let them know that we believe companies that manage their environmental and social risks proactively, lead to better risk-adjusted returns. So let me give you one example, Sean. One of the engagements, that's been running for a long, long time. Suncor has been like for over a decade of conversations. We've told them that we believe that the future is a low carbon world, and we really encourage Suncor to start thinking about that and to be much more transparent on how they are transitioning to a low carbon world. And so what we did, in fact, in 2016, is we filed a shareholder resolution asking them to be much more transparent on that. And we actually won that shareholder resolution. And in fact, actually, as a result of this work, in June of this year, Suncor actually announced their plans to be a net zero carbon company by the year 2050. They have some of the brightest energy engineers in the world. They solved one of the hardest engineering feats, which is to squeeze oil out of sand economically at $50 a barrel. And we believe very strongly that these bright energy engineers can solve a net zero and provide solutions on that side. So that's one way that we help this transition to a low carbon world. And finally, I think that our sub-managers are doing incredible work here. And so, let me just say this, Sean. I'll just give you one anecdote. And I call this summer really the summer of destruction. And why do I say that? Because, the climate extremes that we've seen here have been so extreme. You look at Lytton, BC, Lytton, BC, I call it that, in the summertime, they hit Death Valley-like temperatures, 49.5 degrees Celsius, set new records in Canada in terms of record high. And then a couple of days later, they got burnt down by a forest fire. On the east side of the country, New York City, the exact opposite. They had these incredible floods in New York City. And you look at the videos of the New York subway systems, you had people actually had troubles getting out of their basement apartments because the water was going down there so quickly. And so, this type of climate change risk creates physical climate risk for companies in the way that they operate in terms of their head offices, their factories, their distribution centers, and their physical infrastructure. So one of our sub-managers, Impacts, is doing a physical risk assessment of climate change on every company in the S&P 500. And why is this important? Really is that, as a business, you really have to gauge what is your exposure to increased climate damage. So for instance, if you are a utility and they found this utility and they have electric grid and they run these electric wires down, and those electric wires are now in a new hurricane alley, are they prepared for this? And so we're asking all of these questions. If the company has good answers, we give them better valuations. If the companies better valuations than companies that aren't thinking about or are not managing these physical climate risks. So, maybe those are a couple examples of why it's important to us and why we think it makes a difference on your investment portfolios.
No, certainly it is certainly a larger issue, a global issue that needs a lot of attention. And as an asset manager, I'm glad to see that you're engaging with the companies directly, that you're participating in shareholder resolutions. When we hear of RI investing, sometimes it's just screening out certain equities. But I think the difference here, and correct me if I'm wrong, John, is that you're very active in this space in trying to create change and not only exclude certain equities or positions because it meets a certain mandate that you're trying to achieve. And I think that's really important to a lot of our membership on how active we are. But I do have to ask the question, and this question does come up sometimes, is when we're looking at responsible investing as an option, there's a myth out there that says performance is impacted by responsible investing or those choices you make. And I think you did allude to that earlier, that is actually the opposite impact, but perhaps you can just comment on the whole performance aspect as it relates to client returns in their investments.
Yeah, no, I think this is a super important question. And again, like I said, there's been literally thousands of academic studies and both practitioners as well. There's been a landmark study that most of us point to. It was done in 2015, and it looked at 12 or 1,400 academic studies and found that 90% of the equity studies have really found positive or non-negative impact of applying RI screens to investment returns. New York Stern University did a refresh of this last year, and they looked at the last 1,000 studies that have been published since 2015, and they found even stronger conclusive evidence that by applying this ESG analysis of environmental and social and governance to your process actually has very strong positive correlations to not short-term returns, but long-term returns. And I think this is an important distinction because, one of the things that we're very cognizant is that a lot of your members are saving for retirement and other long-term objectives. And so we just want to make sure that these companies are managed from a long-term perspective, not just, trying to beat short-term quarterly results. And so when you're looking for, as a long-term investor, what your investment performance is over 3, 5, 10-year time horizons, these ESG issues are actually more important in terms of the value creation than the non-ESG issues. And so, yeah, absolutely. What we're finding, and this is really interesting, is that, that because of the ESG has added a new tool or dimension to investment practitioners. So if you look back over the last decade, 2 decades, actually it's 50 decades, not 50 decades, 50 years or 5 decades, you've seen that, really portfolio optimization and, has really been optimized along 2 dimensions, which is risk and return dimension. And so really what we've asked you is, okay, how much risk are you willing to take? And then what we do is we say, okay, for that level of risk, here's how we maximize your returns, and we optimize portfolios that way. But with the ESG tools, we now have the tools to be able to optimize portfolio along the 3rd dimension, which is real world impact. And so what that means is you can take 2 portfolios with very equivalent risk and return, expected risk and return metrics, and create portfolios with the exact same expected risk, expected return. One portfolio has measurable positive impact on the environment and social considerations. One has no measurable impact. And what we're finding in 2020 is that this was very important to investors. And so they're increasingly choosing portfolios that have positive impact. So we can optimize portfolios, exact same risk and return metrics. One just has positive impact, one doesn't have it. And that's exactly the path that NEI is taking for sure.
Right. So if you have the option to choose between 2 similar portfolios that are similar on the risk and return spectrum, why would you not choose that has something that has a positive impact, correct?
Exactly.
Yeah. So maybe we'll shift gears just a little bit. We're seeing a low interest rate environment. We're at record lows, and there's been predictions of rate increases coming into perhaps late next year, and the concern is, what impact will this have on the markets going into late 2022, 2023? Are we, going to see a pullback in the market at that point in time? And not really looking for the market outlook, but really, what is the impact of interest rates going to have, and what impact might it have on the housing sector as well? Because we have seen a hot housing market, across the nation. And I believe Canada, in a chart I saw recently, was the fastest growing market by a large variable over all the industrialized nations across the globe. So correct me if I'm wrong there, but certainly we've seen this boom in the market, and we want to know what the impact on interest rates could have, as a rise in interest rates could have on both the housing and the markets.
Yeah, no, very, very important question. And one of the main reasons I cited for the strong equity markets that we've seen here is that valuations are so high because the interest rates are so low. So, let me just quickly talk about why interest rates matter to the equity markets, and then address your question. So, really, the lower interest rates go, the more future earnings are worth to an investor on a discounted cash flow basis. So that's very technical, but again, if you have a growth company and they're earning $1 10 years from now, and you have high interest rates, then that's not really worth much in today's dollars. But if you take the interest rate you have it, that $10 is worth more in today's dollars than it would be than at a higher interest rates. And so that's why interest rates matter. And so what you see is PE ratios go up and down depending on interest rates. And so, Again, let me say that we're at a point where both the Bank of Canada and the Federal Reserve have their key interest rates at rock bottom rates at zero, near zero. And so, it doesn't take rocket science to really say, I think interest rates need to go up. But the question to you to ask is just a matter of time of when and how much and how fast. And luckily, the central bankers have given us a three-step roadmap. And that three-step roadmap is this: is number one, we need the economy to heal. So the two indicators central banks are looking at in terms of the healing of the economy are inflation and the labor market. And I'll get more on that in a second. The second step is that once the economies have healed, labor markets have recovered, inflation's at normalized levels, then the central banks can go and take stimulus off the table. And first, what they do is they reduce their bond purchases. And the Federal Reserve in the US, for instance, is buying $120 billion of bonds a month to ensure that A, there's liquidity in the bond markets, and B, to keep interest rates low. And so before the Fed starts raising rates, they need to wind down these asset purchases down to zero. And this is the so-called tapering their asset purchases. And this is why the markets are so focused on this, because once they announce that they're going to start to taper, that really starts that whole policy normalization. And then once they take their asset purchases down to zero, they can start raising their key rates. And so on that first point, needing to heal the economy, the reason why, Sean, this is so important, and a lot of people don't realize this, but the problem that we've seen in regions around the world when we've had these financial crises is that the danger of removing stimulus before the economy is completely healed has created some really bad economic outcomes that are long lasting. You look at Japan. Japan had their asset bubble burst in 1990, and they've suffered decades of deflation and low growth, and they're still struggling with it. Europe, has endured over a decade of low inflation and low growth since the global financial crisis, and even in the U.S., where you haven't had that suffering. 0809 was very suboptimal just because they took stimulus off the table way too early. And that's why they had this so-called jobless recovery. And we've been talking about this jobless recovery for years and years and years after the recovery in 0809. Even though equity markets recovered, the jobs didn't recover. And so, and that's really led to, this polarization that you've seen in the US, where the very wealthy do really well and the rest of the population doesn't do well. And so, the policymakers have learned their lessons. And what they're trying to do is they're trying to err on the side of caution. And then they really want, this for waiting for both inflation and employment to return to pre-pandemic levels. Inflation on both sides of the borders have been extremely high. We saw that in July and August. But these numbers were distorted by quote unquote base effects, where we had extremely low numbers for hotels and airline travel and used cars last year. And so when a year over year, they look pretty good. And so the Fed has signaled to their belief that these high inflation rates are temporary, driven by things like used cars, hotels, restaurant prices. And so, the inflation numbers came out this morning in the US. And again, it seems to collaborate that, yeah, indeed, they are temporary. So we'll move on to employment. And,
Sorry, John,
there's 5 million.
Can I interject for just a second
Oh,
there?
please do. Please do.
I don't mean to cut you off, but I do.
No, it's good. This is all good. I like it.
On your point on inflation, I mean, you mentioned we did see the inflation numbers come out this morning. I think it was 5.3% in the U.S. And we look at shortages that are still occurring. We talk about a chip shortage, in the transitory effects or inflation being transitory because it's catching up. Do we see this transitory inflation continue? Is that the view that it will continue for some time? Because when we're looking at the normalization of the market, you did mention the first step is inflation and labor. And, for our membership, they will say, my personal inflation rate has gone up because I'm paying more for my groceries and everything else.
Yeah,
and it's hard to find labor for certain jobs, and the market is becoming a little tight. So I just wanted maybe if you could expand on that a little bit.
Yeah, no, thank you. And again, you did plug this as a conversational webinar, so let's have a conversation. So this is great. Yeah, no, on inflation, no, absolutely. Areas of concern for consumers clearly are food, energy, gas prices, as well as housing. And I haven't touched on housing, but absolutely on food. And again, the view is that as one of the as you begin to reopen the economy, you've seen real supply issues. And I was talking to someone on my team. They spent the last week they had off looking for furniture. He's a young guy and moved apartments and was looking for a new couch. And he was told that depending on the couch, he might have to wait 3 to 6 months
Wow.
for delivery of that new couch. I know that for me over the summer, I had to get my son's bike fixed, so I went to the local bike shop, Mountain Equipment Co-op, and they had a sign and they said that, look, you know what, if we need to order bike parts, it might take 300 days to 360 days to order in the bike part, depending on what it was. And so we're having these real supply chain issues where it's hard. You're seeing this big demand on anything doing with the home. We saw lumber prices really take off earlier in the year. But what we're seeing is that as the year goes on, that those supply chain constraints are beginning to loosen up. Demand begins to normalize. The factories can come out, and so again, we saw a 100% increase in the price of lumber this year. And I think we all saw headlines that what you haven't seen is that lumber prices have corrected now almost to the same level as they started the year at. So you've seen this normalization, and we expect to see that normalization on a number of issues. So used cars, as chips begin to become again a little bit more widespread, you're going to see supply of autos begin to increase, and things of that sort. So we do think that there's going to be a normalization. What that normalization looks like is subject to debate. Can we have a period of a little bit higher inflation than we had pre-pandemic? Probably. And that might happen. Wage, for instance, is really interesting on your side, because I just came back from I had a son that just got his first full-time job actually at Tesla in California, in San Francisco. And so he tells me there that that everywhere he goes, there's there's these help wanted ads everywhere, grocery stores, drug stores, everything. And people are really looking for jobs, and so this is why when we look at responsible investing, one of the factors we look at is labor relationships. And are you a company that takes good care of your labor? Are you paying them well? Do you have good health benefits and days off and things of that sort? Because those companies that do treat their labor force really well, they're not seeing this big input in labor costs, but they're able to hang on to their labor force. In fact, actually, I was just looking at the earnings transcript of a well-known Canadian company retailer, Lululemon. And so what they said, in their latest transcript is that, because they've been treating their workers so well, and people have always been a priority for them, the productivity of the Lululemon stores now are at the same level or even higher than the same store sales pre-pandemic, and that's really an incredible offer. So again, I think inflation it has a way of working its way through the system. It's going to be a little bumpy here for a little bit, but when you look out 1 year, 2 years, and 3 years time, we do expect to see those inflation numbers to come down to much more normal-like levels.
Fantastic. So, I mean, that's the, we talked about the market recovery a little bit, what needs to be in place in terms of inflation in labor. But there's one exogenous factor, which is this pandemic that seems to rear its head every year. And, we're, I guess, for all intents and purposes, calling it a fourth wave now. What is the view of the asset manager view, NEI's view on, the pandemic, vaccination rates? Do we see a longer, deeper, protracted, fall with this pandemic, and consequently, what impact could that have to markets in portfolios?
Yeah, no, great question. And again, number one, I think that the main message here is that vaccinations work. And that's what the science has shown us, that if you look at most of the new cases and certainly most of the hospitalization data, I can tell you that my wife is watching this on a daily basis, and so I get my daily report from her. And again, 90%, 80% of the new cases are amongst the non-vaccinated people, and that's why even though cases have been going up, hospitalizations are not at the same levels as they were when we had an equivalent third wave and second wave. And so so it's certainly important that we continue the work on increasing the vaccinations, and because if you have double vaccination, we know that the worst health outcomes of hospitalizations and worst case scenario deaths are extremely much lower than if you're unvaccinated. The second thing I would say, that even as new cases rise, we certainly don't expect a lockdown like we had in the past. Certainly, here in Toronto, we've endured what some are dubbing the longest lockdown in the world when you compare it to Paris and London and New York and all these other cities around the world. Certainly, we were locked down much longer than that. And so, the appetite for not just us, but economies and large markets around the world are really, we're going to try to avoid that. So, we just don't expect as big an impact on the fourth wave. And I think, I think the point here, and I think all of us are slowly coming to this realization, is that, we're this isn't kind of a one and done thing, and that there's a pandemic and then it finished. There's going to be a long tail to this, and we're going to be living with this pandemic and the Delta variant and all the variants afterwards for a long time. And so I think Canada's done remarkably well. One of the leaders in terms of vaccination rates, and my only view here is let's keep this up and make sure that even as new cases go up, that we continue to reduce the health and economic outcomes by getting vaccinated.
Would you say, John, that the pandemic, in other developing countries, could have a further impact on supply chain disruptions as well?
Yeah, no question. I mean, we are, one of the things that that the pandemic in 2020 really highlighted was the dependence on supply chains, and that really one of the things about economic efficiency and the way that we really practiced economic efficiency it was that that shareholders were supreme. And the only thing that, if you're only managing to satisfy the shareholders, then what you want to do is you want to maximize profits. The way that you maximize profits is you minimize costs. The way to minimize costs is you put all in on a factory way out in the very low cost labor area, and reduce costs as much as you possibly can. Well, and we saw in 2020 that there's risk to that model, and that there's risk to it in terms of companies locking down, in terms of transportation. We saw that the Suez Canal, that a tremendous blockage of goods, and so we're now seeing that that we need to diversify our supply chain a little bit, and markets and companies are getting a little bit better at making sure that they have supply chains a little bit closer to home, and on the margin that's going to help the labor market here. But it's not going to be the same jobs as the past, and as we start to transition to this low carbon world, what we're trying to figure out is how do we create factories and create goods and services that have that have low carbon impact, and that's where we're seeing a lot of growth in as well. So absolutely, this whole access to localized supply chain is becoming more and more important as retailers and manufacturers begin to really understand their global supply chain and all the different factors and the complexity that creates for them.
Yeah, it almost sounds like we're moving a step back from more globalization to sort of a bit more independence in terms of the country that we operate in.
Yeah, no, I wouldn't say a huge step back, but certainly on the margin, what we are doing is we're beginning to become much more aware of having all your eggs in one basket. And so I wouldn't say it's a step back from globalization, and rather than it's really a more sophisticated approach to risk management, for sure.
Excellent. So let's again switch gears. So we've got an election coming up in Canada. And, I wanted to perhaps get your views on, is there anything that, you can comment on the potential impacts of the various parties that might have on, the economy and you as an asset manager, what you're looking for in terms of certain policies?
Yeah, no, absolutely. I'm going to try to get through this, Sean, without getting myself in trouble. But again, I do want to acknowledge that some of your listeners might be like my wife, who is a little bit upset actually that we're going to a polls during a pandemic. If that is you, you're in good company, because I saw it, and I told her this, that I saw a recent poll that found that almost 60% of Canadians believe that we shouldn't be having an election, this soon into the government. But having said all that, what I am going to say is that please don't let that stop you from exercising your democratic right. And I would say this in all full seriousness, that I think this is one of the most important elections that we have as a country. And the reason why I say that, and I'll tell you where it's not a big issue. And it's not a big issue from a fiscal standpoint, because from a fiscal standpoint, the platforms are actually pretty even. When you look at each major party's election platform and you cost that out, there's not much difference from a budget deficit perspective. I'll give you an example. The Liberals say that they would spend, they would raise spending by 80 billion over the next 5 years, partially offset by revenue increases, i.e. taxes in the form of large corporations, by 25 billion. This net new spending is less than 0.5% of GDP. So not a big deal. Conservatives, on the other hand, will have an even bigger deficit in the first fiscal year, and their platform envisions a deficit of $10 billion larger, deficit larger than the Liberals in the first year, followed by a tightening of the fiscal belt in the second year, with a plan to balance the budget 10 years from now. So again, when you look at this over the two parties over the first 10 years of their plans, and you tally the difference between the two deficits, pretty immaterial between the party platforms. But I tell you where there is a big difference is the approach to climate change, and this really hasn't been getting a big part of the conversation. And again, it doesn't surprise you from the conversation that we had at the beginning, that we at NEI think climate change is a pretty big deal. We think it matters from a risk perspective. We think it matters from a returns perspective. We think it matters from a human perspective. We think it matters from a competitive positioning perspective. And so, again, with Canada warming at 3 times the global temperature rise rate, we have more to lose when it comes to global climate change. We're the only G7 country whose emissions are substantially higher than the 1990 levels on a per capita basis. And so, we're the second largest supporter of fossil fuel subsidies in the world. So, we think it's really important for voters to really look at, where each party stands in the direction they want to take the country. Because, you look at where the US is doing, what Europe is doing, what China is doing. They're all making substantial progress on moving their economies, their countries, their industries, their countries to a net zero world, including renewable energy infrastructure, electric vehicle transportation networks, home improvements, et cetera, et cetera. And like I said, this is a $5 trillion opportunity. And we need to create jobs and incentives for companies that in sectors that will be growing over the next decade, not shrinking. And if you look at the IEA, this is the International Energy Association, really the global think tank on energy. When they look at net zero, their world in 2050 looks like coal demand falls by 98%. Oil demand falls by 75%, and natural gas demand falls by 55%. So, there's lots of opportunity here on a go-forward basis to create, jobs that in sectors that are growing. And so, I think that that's the real bottom line, is that if we want to look at our competitive advantage, in terms of the global, we can be a global energy leader in energy infrastructure in this new world, or we can take a walk backwards. And I just encourage all of our listeners and webinar members to take a look at this and vote as they see fit.
Yeah, and I think there was a comment that came through on the chat that many Canadians are calling it a climate election, and so we certainly do encourage you to exercise your democratic right and vote and so forth. I just a quick comment. I went and did the advanced voting, and I have never seen it so busy. I think there's a a lot of individuals who are very keen on, being heard this time around. And so certainly we'll see what will happen, in the very near future with regards to the election. So we're approaching the end of our webinar. And John, I wanted to give it back to you just as a final comment to say, as an investor, as a member, what would you recommend in terms of a go forward basis? If I'm looking to invest today, or if I have investments, should I be making changes? Should I continue with my current strategy? Obviously we're seeing, various different factors that are coming, from the political front, from the climate front, from the pandemic, as well as the markets. A lot of this can be overwhelming at times. So, as a member, I just want to know, what should I be doing today? Do you have any, broad-based comments that you can share with us?
Yeah, no, I'm really super happy that you asked this question because, I think that we're increasingly concerned about a market pullback. Given where we are, I don't know the reason why, but a lot of people say, so John, why is that? But again, we know that September, October is a month of unusual volatility. It'll go back to 87 and 02 and 08, 09. And it's at a time when growth is slowing. We also are expecting announcements from the Fed that they're going to start tapering their asset purchases. So and we've gone a substantially long time ahead. We haven't seen a 5% pullback in the market since October of last year. So we wouldn't be surprised to see some pullbacks in the markets. And and I don't know what the catalyst is, but there's going to be something that spooks the market. And I would just say that we would treat this as we have all the other market pullbacks, and use as an opportunity. We certainly encourage well diversified portfolios. We think there's places in each portfolio for equities and bonds. And again, if there's a pullback in one or the other, we think that there's an opportunity there to really balance your portfolio. So if you my main message here is that we think that economic growth on a go forward basis should remain strong, driven by very stimulative fiscal as well as monetary policy. Even as that stimulus gets taken off the table, it's still fairly accommodative. And so that earnings growth should translate to relatively good equity returns. And we think that as interest rate rise, that favors equities over bonds. And within the equity markets, that probably puts a bit of a headwind on the growth sector, such as technology, as it hurt their PE multiples more than more some of the more value oriented companies and financials certainly benefit historically from rising interest rates. So I think that I think it's a good time to stay the course, even if there is a little bit increased volatility in the markets over the coming months.
Great. John, I wanted to thank you for your time today. I think this has been wonderful, great conversation. A note to all of our members on the call, if we did not get to your questions, certainly you can ask further questions at wealth@alterna.ca, or if you'd like to speak to a wealth advisor, again, wealth@alterna.ca, and we will endeavor to get back to you as quickly as possible. We will be hosting another webinar on October 5th on the roles of an executor. This seems to be a timely and interesting topic, and certainly one that I would encourage you to look out for. So please keep an eye on your inbox for that. And again, if there are any other questions or concerns, we certainly want your feedback. We will send out a survey regarding this, and I hope you enjoyed this format today. Thank you, everyone, and we will see you on our next call. Thank you, John.
Okay, bye-bye.